Welcome back to Boring Currency. January 22nd, 2026. Silver just hit $95.87 per ounce, a new all-time high, breaking the 1980 record that stood for 46 years. You would think this is a celebration. You would think the dealers are swimming in cash, but something is very, very wrong. We are receiving reports from the wholesale market that make no sense. Not anecdotal reports, hard data, trade sheets, inventory logs, and the numbers reveal a paradox that should not exist in a functioning market. On one side, sold out. American Silver Eagles, sold out. Canadian Maples, sold out. 100-ounce bars, sold out. Every major product line. Shelves are empty. Premiums are exploding. Retail demand is up 400% year over year. We expected that. We have been tracking the shortage since October 2025, when London lease rates spiked to 39%. But here is what makes no sense. On the buy side, the side where wholesalers pay you for your metal, multiple distributors are showing extremely limited buying capacity. Some are restricting purchase volumes. Others are widening bid-ask spreads to levels never seen before. In a normal market, when supply is tight and demand is infinite, buyers fight for every ounce. They raise their bids. They compete. But today, the buying mechanism is seizing up. Why? The answer is not a lack of demand. It is a lack of liquidity. And if you understand what that means, you understand that we are not watching a bull market. We are watching a system failure. But before we dissect the mechanics of this collapse, I need to show you something. Because what I am about to explain, the credit freeze, the margin trap, the inventory depletion, this is not a 15-minute YouTube summary. This is a 47-page forensic breakdown. And I have documented every single data point, every COMEX withdrawal, every LBMA vault draw, every lease rate spike, every Chinese export restriction, in Die Finanz Recherche, all the data, all the sources, all the connections I cannot show you in this video. The silver liquidity crisis documentation, plus Venezuela, dollar system, gold, and every new analysis I publish, one access, all documentations, permanently. Link in the description. But now, let me show you what is happening right now. To understand the wholesale collapse, you need to understand the infrastructure. The precious metals market has three layers. At the top, the refineries and mints. They produce the metal. At the bottom, you, the retail buyer. In the middle, the wholesale distributors. Companies like APMEX, JM Bullion, SD Bullion. These are not retail shops. They are the authorized purchasers. The entities that buy directly from the US Mint and distribute to thousands of local dealers. They are the pipelines. And on January 22nd, 2026, the pipelines are dry. Why? Because between early January and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery. That is 26% of registered inventory gone in 1 week. This is not normal market activity. This is a run. A physical run on a paper system. COMEX registered inventory has collapsed 70% since 2020. London LBMA vaults are down 40%. Shanghai inventories are at decade lows. At current consumption rates, some industrial hubs have 30 to 45 days of accessible reserves. That is it. And then, on January 1st, 2026, China implemented new export licensing on refined silver. Not a quota, a reclassification. Silver is now a strategic material, same category as rare earths. Only 44 state-approved firms can export. They need annual output of 80 tons minimum, credit lines above $30 million, government approval. This effectively ring-fenced 65% of global refined silver supply for domestic Chinese use. The global market just lost 2/3 of the world's largest refiner overnight. So you have a COMEX bleeding inventory, you have LBMA at multi-year lows, you have China export lockdown, and you have industrial demand from AI infrastructure, solar panels, electric vehicles, consuming 60% of total global production. The math is simple. Demand is 1.24 billion ounces. Supply is 1.01 billion ounces. Deficit of 230 million ounces. Fifth consecutive year. The total cumulative deficit since 2021 is now 820 million ounces. That is an entire year of global mine production. Evaporated. This is why the price went vertical. Silver was $25 in early 2025. By October, it broke $50. By January 2026, $95. That is a 280% move in 13 months. And this is where the wholesale crisis begins. Because these distributors, they do not operate like investors. They are not stackers. They are logistics companies. Their business model is volume. Buy at spot plus $1. Sell at spot plus $2. Make money on the spread. They do not care if silver is $10 or $100. They just want to move metal. But they have a problem. Between the time they buy 1 million ounces from the refiner and the time they sell it to the dealers, the price might drop. If they buy at $50 and it drops to $40, they lose $10 million. That wipes out an entire year of profit. So the banks that lend them the capital force them to hedge. When the wholesaler buys 1,000 ounces of physical silver, they immediately short 1,000 ounces of paper silver on COMEX. This is called being delta neutral. If the price falls, the physical loses value, but the short makes money. Perfect protection. Except when the price goes vertical. When silver rocketed from $25 to $95, the physical metal in their warehouses became incredibly valuable, but their short position on COMEX exploded in their face. For every dollar silver gained, the short lost $1. You might say, so what? It is a wash. In theory, yes. But in practice, there's a fatal flaw. The gain on the physical is unrealized. It is just a number on the balance sheet. They cannot access that money until they sell the metal. But the loss on the paper short is realized every single day. Every night, COMEX calculates the loss and demands cash. Variation margin, immediate, liquid, cash. As silver went from $50 to $95, these wholesalers were hit with margin calls in the hundreds of millions. They had to wire cash to CME Group every morning just to keep the hedge open. Where does that cash come from? Operating capital. The money they use to pay employees, shipping, and most critically, to buy new inventory. They are asset-rich but cash-poor, sitting on a mountain of valuable silver, but all their liquidity is being drained by the futures exchange. This is the liquidity trap. And it explains the buying restrictions we are seeing today. Why can they not buy your silver? Because every available dollar is being sent to COMEX to cover a hedge that was supposed to protect them. They hedge themselves into insolvency. The irony is staggering. The U.S. wholesale precious metals industry is being destroyed by the very asset they sell. And there is more. The banks are pulling credit lines. When silver was $20 and stable, banks would lend 90% of inventory value. Now, with silver at $95 and volatile, they are cutting that to 50%. Even though the inventory is worth more, the dealers can borrow less. This is the collateral crunch. And it gets worse. A wholesaler with a $100 million credit line could finance 4 million ounces when silver was $25. Today, at $95, that same $100 million finances only 1 million ounces. The capacity of the industry has shrunk 75% just because of the price increase. The pipe got smaller. This is why we are seeing limited buying capacity. It is not that they do not want your silver. It is that they cannot write the check. The bank computer says, limit reached. The credit lines are maxed, paying margin calls. The system is locked, and this freeze is spreading. Think about your local coin shop. They rely on selling inventory back to wholesalers to manage cash flow. If the wholesaler cannot buy, the local shop is trapped. They buy silver from the public, but have nowhere to offload it. They run out of cash. Then they restrict buying too. This is a cascading failure, from the bullion banks to the wholesalers to Main Street. The velocity of silver has dropped to zero. The visible symptom is the premium explosion. In Shanghai, physical silver is trading $12 to $13 above COMEX spot, a 13% premium. That is extreme by any historical standard. Some reports suggest private physical transactions in certain markets are clearing significantly higher than exchange prices. Why? Because paper and physical have disconnected. For 50 years, silver price discovery happened on COMEX and LBMA. But when 26% of COMEX inventory vanishes in 7 days, when lease rates spike from under 1% to 39%, the paper market loses credibility. The physical market is repricing on its own. London lease rates tell the whole story. In a normal market, you can borrow silver for 0.3 to 0.5% annually. In October 2025, the rate hit 39%. Today, it is still 11%. Why would anyone pay 11% just to borrow silver? Because there is not enough physical metal to meet delivery demand. When institutions are willing to pay double-digit rates just to secure metal on time, that is not a market. That is a crisis. And the paper-silver system, the ETFs, the futures, the unallocated accounts, they are under extreme stress. ETFs rely on authorized participants to source metal for creation and redemption. But when physical silver becomes scarce and lease rates explode, those participants cannot source metal. ETFs start trading at discounts to NAV, redemptions get suspended. In an extreme squeeze, ETF shares keep trading while the underlying metal disappears. This is the nightmare scenario for paper holders. You own a claim, but the claim is worthless because there is nothing to claim. The recycling loop is broken too. Local coin shops used to buy silver from the public, grandma's silverware, old bars, and send it to refiners. That recycled metal fed back into the system. But if the shops cannot buy because they have no cash, that silver stays in the drawer. It never reaches the refiner, never reaches COMEX, never reaches Samsung. Secondary supply is collapsing, mining supply is flat, demand is up 400%, and recycling is dead. This is a supply cliff. So where does this leave us? The infrastructure has failed, but the demand has not. People still want silver, industries still need silver, and if the traditional dealers cannot facilitate the trade, the market will find another way. We are returning to peer-to-peer. Direct, private, no middleman. This is how silver traded for 5,000 years before COMEX existed, and it is how it will trade again. In the next block, we are going to explore the death of the middleman and the birth of the gray market. We are going to analyze what happens when the only price that matters is the one your neighbor is willing to pay. The revolution is not televised, it is transacted in person. Stay with us. We are back, and if you were with me in block 1, you now understand the full scope of the wholesale collapse, the margin trap, the credit freeze, the inventory bleed. The system that moved silver for 50 years has snapped. So what happens now? Does the silver market die? Does your stack become worthless because you cannot sell it to a dealer? No, the market does not die. It evolves. It returns to its original form. We are witnessing the birth of disintermediation, cutting out the middleman. For decades, we relied on the infrastructure. We relied on dealers to ship us coins and buy them back. We paid premiums for convenience. But the convenience is gone. The middleman is insolvent. And when the middleman dies, buyers and sellers find each other directly. This is not a new concept. This is ancient. You do not trade with a bank. You trade with your neighbor, your mechanic, the farmer down the road. In a peer-to-peer market, the price is not set by an algorithm in Chicago. It is set by the two people in the room. And right now, credible reports from private forums and local trading groups suggest physical silver is clearing significantly above official spot prices. Why? Because in a private deal, there is no bid-ask spread. There is just the price. And that price reflects reality, scarcity, trust, urgency. This creates what economists call a gray market, a market outside the banking system, outside tax reporting thresholds, outside regulatory visibility. It is pure privacy and pure liquidity. And here's the critical insight. The wholesale collapse is actually bullish for silver in the long run. Why? Because it kills the leverage. When a wholesaler buys silver, they short it on COMEX. That suppresses the price. But when you buy silver from your neighbor, nobody shorts anything. The metal changes hands. The paper market is bypassed. A peer-to-peer market is one-to-one. No derivatives, no rehypothecation, just metal and cash. This removes the paper anchor that held silver down for decades. So what is the real price of silver today? We are looking at a permanent bifurcation. There is the paper price, COMEX, futures, ETFs, and there is the physical price, street deals, private transactions, industrial contracts. The gap between them is widening. Shanghai is trading $12 to $13 above COMEX. That is verifiable. Exchange data, public record. Some private sellers in tight markets are reportedly achieving premiums of $20, $30, even $40 above spot, depending on form and volume. Is this sustainable? Maybe not, but it reveals the stress. Let's speculate for a moment. If the current trajectory continues, if COMEX inventories keep bleeding at 30 to 40 million ounces per week, if China maintains export restrictions, if industrial demand remains relentless, what happens? We could see a scenario where COMEX becomes a settlement mechanism for institutions only. Paper contracts cash settled, no physical delivery. Meanwhile, the real physical market, the one where actual metal changes hands, moves to its own price discovery. Street price, $150. Screen price, $100. A $50 trust premium. The price you pay to know your wealth is real. This is not fear-mongering. This is pattern recognition. We have seen this in other commodity markets. Lithium, rare earths. When export controls fragment supply and industrial demand spikes, the physical market decouples from futures. Price discovery moves to private contracts. Transparency disappears, and whoever controls the physical supply controls the price. Right now, China controls 65% of refined silver. They just locked the export door. Do you think they are going to let that metal flow freely to the West while the U.S. industrial base is screaming for supply? Or do you think they are going to use it as leverage? Let's connect this to the bigger picture, because silver is not just a commodity. It is not just an industrial metal. It is a monetary metal. And in times of currency crisis, monetary metals revalue. We are seeing unprecedented fiscal stress in the United States. The debt is $36 trillion. It grows by $1 trillion every 100 days. Interest payments alone are over $1 trillion annually. The Federal Reserve is trapped. If they raise rates, they crash the economy. If they lower rates, they ignite inflation. And if they try to hold steady, they watch the bond market implode. Japan just experienced a bond market crisis in mid-January 2026. Yields spiked. The yen weakened. Safe haven demand for gold and silver exploded. That is why silver hit $95. It was not retail speculation. It was institutional fear. When the world's third largest economy has a debt crisis, capital flees to hard assets. And silver, with its dual role as industrial and monetary, becomes the perfect hedge. You are hedging against inflation and you're hedging against the collapse of the tech supply chain. This is the monetary reset thesis, and it is not a conspiracy. It is thermodynamics. Every fiat currency in history has eventually failed, not because of evil bankers, because of math. You cannot print infinite money and expect it to hold value. The dollar has lost 98% of its purchasing power since 1913. The only reason it has not collapsed yet is because it is the global reserve currency. But that status is eroding. BRICS nations are trading in local currencies. China and Russia are settling in yuan and rubles. Saudi Arabia is accepting yuan for oil. The petrodollar system, the foundation of American monetary dominance since 1974, is cracking. And when the dollar loses reserve status, when central banks stop buying treasuries, when the world stops accepting dollars for real goods, the dollar will collapse. And when the dollar collapses, what do you want to own? Paper promises? Or physical metal? The wholesalers bet on the dollar. They shorted the metal, they hedged against reality, and now reality is calling the bluff. The metal is revaluing, the dollar is devaluing, and the only people who are solvent are the ones holding the unencumbered asset. Let's talk about the industry wipeout, because the credit freeze is not just hurting wholesalers. It is killing local coin shops, small businesses, independent dealers, mom and pop operations that served the silver community for 50 years. They are facing an extinction event. Why? Because they operate on cash flow. They buy silver in the morning. They sell it in the afternoon. But if the wholesaler cannot buy back their excess inventory, the local shop is stuck, cash tied up in metal. And you cannot pay rent with silver eagles. You need dollars. If the shop cannot convert metal back to cash, the shop goes under. We are predicting a wave of closures in the coming weeks and months. Not all shops, but many. And when the small players die, the big players consolidate. We will be left with 3 or 4 corporate giants. Less competition. Higher premiums, more control. This is not a conspiracy. It is capitalism. Crisis accelerates consolidation. And in this crisis, only the cash-rich survive. But before we talk about survival strategies, I need to address something directly. Trust. We are in a collapse of trust. Trust in the financial system. Trust in the dealers. Trust in the paper markets. But there is also a collapse of trust happening on this platform. We have seen an explosion of copycat channels. Channels using our name, using this avatar. Stealing our scripts, word for word. Reposting on Twitter, TikTok, even here on YouTube. They are monetizing your fear without doing the work. I want to be absolutely clear. We have one channel. This one, we are only on YouTube. We do not have a Twitter account. We do not sell crypto on Telegram. We do not have a WhatsApp group asking for money. Anyone else using this name is a fraud. We do not take responsibility for their bad information or scams. So I am asking for your help. If you value this content, if you value the truth, signal boost the original, go to the comments, type "staying with the original." Let the algorithm know you are here. Second, share this video. But share the link to this channel. Do not let the copycats win. If you see our content stolen, report it. We are fighting for truth in a market full of lies. We need you on the front lines. Now let's talk strategy. What do you do in this new world? First, self-custody is everything. In a peer-to-peer market, possession is the only thing that matters. If you do not hold it, you do not own it. Second, understand that limited dealer buying capacity is not about the value of silver. It is about the health of the counterparty. The metal is fine. The system is broken. Do not panic. Third, recognize that we are transitioning from a paper-driven market to a physical-driven market. This is the remonetization of silver. It is ceasing to be a financial asset. It is becoming currency again. And currencies do not need dealers. They just need acceptance. At $95, silver is accepted. At $130, it is coveted. At $150, it is essential. The question is not if silver will hit these levels. The question is when. And the answer depends on how fast the system breaks. If COMEX inventory keeps bleeding at current rates, we have weeks, not months. If China opens exports, we have more time. But the trend is clear. The physical market is tightening. The paper market is dying. And the price is going higher. One more thing. The media will try to spin this. They will see dealers restricting purchases and say, nobody wants silver. The bubble has popped. That is a lie. Everyone wants silver. The demand is insane. The problem is the mechanism. The bridge between buyer and seller has collapsed. Do not confuse infrastructure failure with demand destruction. The demand is real, the shortage is real, and the revaluation is real. So here's my final message. The system failed, the credit lines are cut, the trade sheets are empty, but your vault is full. If you prioritized physical possession, if you bought when silver was $20, $30, $40, you are watching this crisis from a position of strength. You're not worried about dealer liquidity. You're not worried about margin calls. You're not worried about credit freezes. You're holding the asset that the entire industrial world is fighting over. And in a world where trust is collapsing, physical silver is the ultimate trust. It does not need a counterparty. It does not need a bank. It just needs you. Thank you for being with us on this journey. We will continue to track the collapse, the consolidation, and the rebirth of the silver market. Share the truth. Ignore the noise. The middleman is dead. Long live the metal. Subscribe. And we will see you tomorrow with the latest developments. This is Boring Currency. Signing off.